Hello everyone, welcome to today's video where we will be talking about the results of Disney for the quarter ended July 1, and we will briefly go over the main points of that report of the entertainment giant Disney, which showed reasons for concern, but there were also promising signs. I'm your host, Nikos Zabouras, Senior Market Specialist at FXCM. Once again, it's going to be a quick take, but before we begin, as always, please read carefully through the risk warnings and the disclaimers. Once again, please read carefully through the risk warnings and the disclaimers, and please bear in mind that anything discussed here does not constitute investment advice and should not be construed as such. Okay, let's get started. So we're gonna talk really briefly about the backdrop, what was going on before the earnings report for Q3 FY 2023, meaning the 3 months ended July 1. Then we're going to talk about what was bad from these results and what was good, which overall, as we said, showed both signs of concern and provide both signs of concern and of promise. And starting with the backdrop, it's been a tough spot for Disney recently and a bit of a roller coaster ride. Thus, this background. It has had some box office misses in terms of its studio performance. At the same time, traditional TV is facing adversities, not only for Disney's assets, but overall, and we saw that in the results of Warner Bros., for example, as well, and Paramount a few days back. And at the same time, streaming is not doing particularly well. Its streaming services, after the meteoric rise of Disney Plus, have been losing subscribers over the recent quarters. And the company is also has been implementing a restructuring plan to change its business and cut costs in order to respond to those difficulties. So that's the backdrop. And now let's move to some of the main points of the report that we had on Wednesday after markets closed. So the bad was that we had another reduction in the user base by around 5% and 11.7 million members. That's the third straight quarter of losses. And let's also see that with this graph and how it does against Netflix. So you can see here on this graph how, although it had moved around a year ago above Netflix, it then started losing subscribers and lost the top spot again to its rival. Now, in terms of overall financials, it also posted a rare loss in this reported quarter of 460 million, following profits of nearly 1.5 billion a year ago. Of course, this was mostly driven by restructuring charges. And then back on the linear networks, financials weren't good there either. When we're talking about linear networks in traditional TV, we're talking about broadcast and cable. Revenues dropped 7% year over year, and operating income was down 35% year over year for that business. Now let's move. That was some of the things that stood out in terms of negatives, but now let's go and see the positives. Although we talked about losing user base, that was mostly driven by one specific region, and Disney Plus Hotstar. After around a year ago, the company had not renewed the streaming, the digital rights to the important cricket Indian matches. And if we think about it in terms of price hikes that has been implementing, the company has implemented, it's also actually quite good. More to add to it, the financial of the direct-to-consumer segment actually improved. Because revenues increased and losses narrowed further. So we're seeing progress there recently. And that was the case again with the latest report. Now, the company also launched late last year an ad-supported tier in the US, which Mr. Iger yesterday said that since its inception, 40% of new Disney Plus subscribers are choosing the subscription tier with the inclusion of advertisements. Furthermore, he also said that this will now become available later this year across select markets in Europe and Canada. And adding to that, referencing this as a positive, the company now plans to monetize on password sharing, following what Netflix did, which worked well so far for Netflix. That's why I'm addressing this as a positive, as a good. And then on the last point, streaming and linear networks had supported Disney during the pandemic, as parks, of course, suffered due to the closures. But now it's the other way around. The Disney Parks and Experiences products segment generated revenues in excess of $8 billion, which was up 13% year over year, and operating income was up double digits to year over year, 11%. So we're seeing steady progress there as well. So these were some of the highlights. That's, again, a quick take on what we saw from Disney on Wednesday. Overall, there was concern and promise. The results were mixed because we lost subscribers, Disney lost subscribers, and the linear networks are continuing to suffer as cord-cutting a trend of cord-cuttings move them towards obscurity. But financials of the streaming business improved. Price hikes have limited impact. The ad-supported tier is doing well and will be expanded. And it also intends to crack down on password sharing, which worked well for Netflix so far. Now, studios have also suffered, but Disney tries to rationalize content output and costs, so there is promise of working there. And of course, let's not forget about ESPN, which does well in general, but it does well in terms of streaming, and the company plans to fully stream it at some point, but we will be waiting for more. So overall, Disney is having a rough patch. That was evident in these results as well, but there were also positive signs. And it's clear that Disney has pricing power from what we see so far in terms of streaming, and overall it has content that it's hard to rival. That's it from me for today. Thank you for joining me.